Why are the technicals casting some cold water out the gates here, Larry?
Historically, the first quarter of year one of the presidential cycle it's a little bit weaker. It's the second weakest quarter in the presidential cycle. So we're seeing some chop here over the past few days, some volatility over the past 5 days. So some seasonal weakness into January, first year of the presidential cycle, is not uncommon.
It's not necessarily uncommon, but we also have a lot of potential policy positions that could impact that. How are you rating some of that potential change here, if at all, Larry?
I think the biggest move that we're seeing right now is a strong breakout in the U.S. dollar over the past few weeks. We've seen a breakout in bond yields. Ever since the Fed cut rates, bond yields have pretty much gone straight up. So I think the market's anticipating some policy changes to a stronger dollar, maybe higher bond yields. And I think that's creating some headwinds for stocks, but I don't think it's going to derail the bull market.
Talk to me a little bit more about that. Currencies is a potential headwind to equities. We also have yields as a potential headwind to equities. You just said that you don't necessarily think that's going to be a huge deal moving forward, but at what point does that risk tip over into something that is a little bit more tangible?
The big number for bond yields is 5% on the 10-year U.S. Treasury. I think we're right around 454. So if for some reason the 10-year breaks out over 5%, then I think the markets would have to adjust lower to those higher bond yields. I don't see it as of yet, but that 5% line, that's the benchmark.
Watch the full episode by clicking below. Try Blue Chip Daily Service for free. Claim your 30-day trial by scanning this QR code or by clicking on the link in the description.